Today we are going to discuss another form of investing in terms of socially responsible investing, and our focus is on bond. And if you can recall, last time we discussed the socially responsible investing from equity point of view. Okay, so equity holder, and now we are going towards bond holder. And if you look at the accounting equation, then on left hand side we have assets, which shows the use of funds, and on the right hand side, we have the sources of funds, which includes liabilities and equity. Last time we focused on equity, and this time we are focusing on liability. And one form of liability is the bond. If the company have issued bond and borrowed money from the investor, and that's the bond. And in that way, you can see the right hand side, the sources of fund, equity and bond, and other sources as well, other types of equity like preferred stock, minority shares, common stock, and then in liabilities, there are different forms, but we are focusing on bond. And once those sources of funds help company to get the fund, and then the company have to decide where to use those funds. And when it comes to socially responsible finance, we are thinking about investors who are bond holders and investors who are common stockholders or equity holders. Do they pay attention to environmental, social, and governance issues in the business model of the company, in the assets where the company is using those assets? Do they really pay attention to? If yes, how they do that? Is it through exclusion, through integration, or through impact, or some other forms of financial instruments? Okay, so that's the bigger picture. We have a quick overview, and if we pay attention to what bondholders look like and what are the features they get, when it comes to equity holders, they do have the voting right. Okay, so like common stockholders, they can vote against or in favor of different aspects or different proposals of the company. Okay, so the equity holders does have that power to shape the decisions and the nature of the business. Whereas when it comes to bondholders, they do not have the voting powers. What they can do, they can put the covenants before they get into the bond agreement, but once they are in, they don't have that voting power where they can attend the annual meetings, and then they can shape the company towards more sustainable finance, towards the way they intend the company to be guided. Okay, so bondholders have that limitation. They don't have the voting power. And when it comes to bondholders, they are mainly concerned about the downside. They are concerned about the safety. They are concerned about the cash richness of the firm so that they can get their interest payment and the principal amount during the course of the bond agreement or bond maturity. Okay. Whereas when it comes to the equity holders, they bear the risk as well as reward. So they also pay attention to downside, but at the same time they also have a high upside potential. So and they get the voting right as well, because of bearing an extra risk, and they have the upside potential as well. So they also have a more right to vote in the strategic decision making of the company, and then guide the company towards the sustainable finance, or the way the equity holders intend the company to be run. Okay, so in this lecture, what we are going to shed light is we are going to say the ESG issues, environmental, social, and governance issues. They are relevant towards the survival of the company or survival of the government of any country. Okay, so what we say is environmental, social, and governance issues. They matter for the default risk or the credit risk for both the corporations and for the governments of any country. So if we can establish that link, that companies and governments that do well on ESG issues, they are better to survive in the long run. So if we can establish that, then it means it is important for us to pay attention to ESG issues before making the credit decisions. And then we will shed light on the ESG integration, that if we have to integrate ESG into bond investing, as it was for the equities, we need to understand the business model if we really have to integrate ESG into bonds. And when it comes to business model, we pay attention to the drivers of the value. So when it came to the equity investing, we said there are three drivers of the value. So we said sales is one, then EBIT margin, and the third one was the capital. And in capital, there was a use of capital and the cost of capital. So that was for equities, and same is the case for bonds. If we have to integrate ESG into bond investing, we have to look at the business model. We have to look at the credit worthiness of the issuer, may it be the sovereign, the government, or any corporation. Okay, so that is what we will pay attention, and then finally we will move on to the new types of bonds or financial instruments that are now becoming very trendy in the market. And we will briefly discuss green bonds, social bonds, sustainability and sustainability linked bonds. And in that way, you can see that from ESG integration, which is the sustainable finance version 2, we will move on to sustainable finance version 3 when we talk about different new financial instruments in terms of green, social, and other types of bonds. Okay, so here is the big picture in terms of integrating sustainability into financial instruments. So today we are focusing on bonds. Sustainable finance version 1, we can exclude companies as an investor that do not meet the preset criteria. And like tobacco companies, war weapons, and other destructive companies, we may not want to give lending or the amount in terms of the debt to those companies. So that's exclusion. So this will not be our focus, but we will be focusing more on sustainable finance version 2, ESG integration, where explicitly we can pay attention to environmental, social, and governance issues in the valuation of the bond and in the bond selection, may it be corporate bond or a sovereign bond. Okay, so explicitly we pay attention to ESG issues in bond valuation and bond selection. And then in sustainable finance version 3, we'll move on to the discussion where uh, we only invest through green, social, sustainability, and sustainability linked bonds. So that is the highest level of the sustainable finance. Okay, so in terms of the learning objectives, we have to understand the state of play of ESG integration into bonds, which can potentially improve both financial and non-financial returns. We have to understand how ESG integration into bonds can bring a deeper understanding of the issuer, mean the understanding of the business model, and then that will drive the credit worthiness and different credit indicators. We have to understand the bond investors are more focused on downside protection and they lack voting power, whereas equity investors, they are more focused on risk as well as the opportunities. So they have focus on both downside as well as upside potential, and they have the voting power as well. And then we have to understand the bond investors have more capital to move and can choose from a wide range of issuers and projects. And finally, we have to identify green bond, social bond, sustainability bond, and sustainability linked bond as an interesting and fast growing innovation. Okay, so if we look at the fixed income market or the bond market around the world, and we can see that the in 2021 the total outstanding value of the bonds in the global sense was 123 trillion. Okay, so this is much larger than what we have seen for the equity. In terms of equity, the global market capitalization was 118. So global fixed income is 123, so larger than equity. And when it comes to global fixed income markets at the bond market, the US is leading the way. So US is comprising 39% of that 123 value, and Europe is second, 20.1%. And when it came to the equity market capitalization, last time we discussed, US was the leading equity market, and the China was the second one. Okay, so but when it comes to the debt market, the second place belongs to Europe, and China comes as the third one, 15.5%. Why it is important to pay attention to the size of the bond market? Because if you have to drive sustainability around the world, then the leaders can play a big role, leading from the front and then helping others to move in the same way. Okay, so that is what is the overall trend in the market. What is bond? So bond is, you can say it's a security, it's a certificate, which is basically can be issued by the government or the corporations, and the bond will promise to repay the borrowed amount, and during the period of the agreement, the interest payment will also be paid by a specified future date. So there are two maturity related dates. So one is the maturity date, at what time the bond will mature, means the date at which the principal amount will be repaid. Whereas the time until the maturity date, also called as the term to maturity, it's basically how much time is left from today till the maturity date. Okay, so there are two types of payments. One is the coupon payment, second is the principal amount. I assume that all of you are aware about that. So coupon payment can be periodic, semi-annually or annual, whereas principal or face value, which is at the maturity date, will be repaid back. So it can be $100 face value, or it can be around $1,000. It can vary from country to country. That face value 100 or 1,000. So if the face value is 1,000 and the coupon rate is 3% annually, then it means that on periodic basis, $30 will be paid on every year on this particular bond until the maturity date. So what if the payment is semi-annually? Then this coupon rate 3 can be divided with 2, and then 1.5 multiplied by 1,000. So it means $15 will be the coupon payment on semi-annual basis. So can coupon payment be zero? Yes, it can be zero for zero coupon bonds. As the name implies, the bonds which does not pay any coupon are called as zero coupon bond. So then you may wonder how they make return. So the coupon bond, if the face value is 1,000, they are issued to the market at a cheaper rate. So they are issued at discount, let's say 800, 700. So through that difference, so the face value is 1,000, but they are issued at discount, the investor will make a return. If you want to know more about bonds, you can click on this link, and more about zero coupon bond, you can click here. It will take you to the related website. And there is also a website, Money Smart, which is an initiative by ISEC, Australian Securities and Investment Commission. So if you go to the website of Money Smart, you can read more about bonds, and there is also very interesting information about other types of instruments. So now we have to talk about different types of instruments, different types of debt, different types of bonds based on the issuer. So the debt can be private debt or can be a public debt. Can anyone give an example of any private debt? Private debt is a debt which is not traded, and public debt is normally a debt which is traded. What do you think? What is a private debt? Any form of private debt? No example of private debt. So private debt is normally the bank debt in most of the cases. Bank debt is a good example of the private debt, and in public debt we have bonds. So our focus in this topic is mainly on bonds. In the topic 9, when we will discuss socially responsible banking and insurance, we'll move on to private debt. Okay, so there are different types of bonds. Bonds issued by the government are called as government bond. Bonds issued by corporations are known as corporate bonds. So in terms of government bonds, there can be supranational bonds, sovereign bonds, and municipal bonds. Supranational are bonds issued by multilateral agencies. It can be IMF, World Bank, and other agencies like that. So any bond issued by them is known as supranational. And sovereign, issued by a government of a particular country, like Australian Commonwealth Treasury. If they issue any treasury bond, they are called as sovereign bond, issued by national governments. Municipal bond issued by state or local government. Okay, so these are the government bonds normally available. When it comes to the corporate bond, there can be a classification in terms of who is that corporation. Is that corporation a financial firm or a non-financial firm? Financial firms are insurance companies and banks in particular. So they can also issue bond, but we say that they are issued by a financial sector. Okay, so non-financial sector, any company like the material sector, consumer staple, consumer discretionary, healthcare and information technology. So all those are non-financial sectors. So any bond issued by those companies come under non-financial sector. So in today's topic, we are not going to talk much about financial sector because banks and insurance, this is our topic of discussion in the next lecture. So we will be primarily focusing on non-financial sector, or you can say corporate bond in general. Okay, so in corporate bond, there can be secured corporate bonds and unsecured bonds. Secured bonds, as from the name implies, have specified collateral. They can be asset-backed securities or the mortgage-backed securities. So any specific asset is used as a collateral. So this provides a security to the bondholder. So in case of default, that collateral can be used to recover the principal amount. Unsecured corporate bonds, as the name implies, they are the bonds that are not backed by any collateral. So they can further be classified as junior and senior bonds. So senior bonds are those who get the repayment if the company defaults before the junior bond, and junior bonds are subordinate bonds, are the last type of the debt who gets the payment if the company default. So in terms of the payment, you can say first the secured corporate bonds will get their payment if the company default, and then the senior bonds will get their payment, and then the junior bonds will get their payment. Okay, so when we compare the government bonds with the corporate bonds, government bonds are less risky because they're backed by the government, whereas the corporate bonds are more risky. So in terms of default risk, government bonds have less default risk, whereas the corporate bonds have higher default risk. Okay, so when it comes to the bond valuation, you can see it's very simple relative to the equity valuation. In equity valuation, there are many assumptions about future. We have to bring it in. A lot of forecasting is involved, in particular for absolute valuation, like discounted cash flow valuation. So you have to forecast sales, forecast future costs, and forecast future cash flows. And then you have to find the discount rate and then continuing value, the growth assumption. So there are a lot of indicators involved in equity valuation. Whereas in bond valuation, you can see the price of the bond or the value of the bond is equal to the present value of the coupon and face value. So if we can find the present value of all coupon payments and the face value or the principal amount, the sum of that is the value of the bond. So here, if you look at, there are two main drivers of the principal, the drivers of the bond value. This P, face value, you can say that's 100 or 1000. That's normally fixed, whereas the coupon rate, coupon payment depends on the coupon rate, 3%, 4%, 5%. So whatever is the rate, you multiply it with the face value, you get the coupon payment. Okay, so coupon rate will determine what should be the coupon payment here in the numerator, and yield to maturity is basically a discount rate that is used to discount all the future payments, including the coupon payment and face value. Okay, so if it comes to the bond valuation, you can see there are mainly two drivers of bond value: coupon rate and yield to maturity. And there is a relationship between these two. If the coupon rate is greater than yield to maturity, the bond is expected to be sold as premium. If the coupon rate is equal to yield to maturity, bond value will be at par. And if the coupon rate is less than yield to maturity, then the coupon is selling at discount. And when we say premium, so it means the market value of the bond is greater than face value. Par means the market value is equal to the face value, and discount means the market value is less than the face value. Okay, so you all have studied this. I'm just giving you a quick refresher before we move into socially responsible bond. How we can, so our question is, what we want to understand here is, we know this is the way we value the bond, how we can integrate ESG into that. Okay, so how we can use ESG issues when it comes to the bond investing, bond valuation. Okay, so in terms of the relationship between yield to maturity and value of the bond, so you can, in terms of mathematical construction, you can see yield to maturity comes as a denominator. So if denominator increases, what happens to the value? The value goes down. So that's very logical relationship. So as the interest rates and bond yields or yield to maturity increases, the bond prices fall. Or the other way around, if the interest rate and bond yields decreases, the bond prices will increase. So there is an inverse relationship between yield to maturity and the value of the price of the bond. Okay, so then yield to maturity, of course, it's related to the riskiness of the issuer and riskiness of the bond, and that is normally gauged through the ratings, the credit ratings. So credit ratings are basically given by independent assessors like Modi, Fitch, Standard and Poor's. So they assess the riskiness of the bond, and we can use that credit rating then to determine what should be the yield to maturity, and then we can use that yield to maturity into our valuation of the bond. So that's one way we can come up with the yield to maturity, but there are many different ways yield to maturity can be calculated. So when it comes to the drivers of the yield to maturity, are the drivers of the credit rating, because credit rating helps to assess the riskiness of the bond, and then based on the riskiness of the bond, yield to maturity can be determined. So what drives that? What drives the credit rating? What drives the riskiness of the bond? Or what drives the yield to maturity? So in terms of the government bond, you can see there are a number of factors which are given by Cantor and Becker. So these are the factors which determine the bond credit ratings, and then ultimately it will affect the yield of the sovereign bonds or yield of the government bonds. And if it affects the yield, then it affects the value of the government bond based on the formula that we have just seen. So default history, GDP growth, inflation, external debt, per capita income, level of economic development and stability. So these are the 6 factors which are given by this Cantor and Becker 1996. Different researchers come up with different factors which are more important than the others in the determination of the credit rating. So but based on this research, so these are the important factors. When it comes to the corporate bonds and what drives the yield to maturity, or what drives the credit rating of the corporate bonds. So there are two important risks that are very relevant to the corporate bonds. So one is the default risk, and second is the liquidity risk. So default risk is how much is the likelihood that the corporation which has issued the bond will be defaulting on its debt obligations. Maybe failure to pay the interest, coupon payment, or failure to repay the principal amount. So if the chances are high that the corporation will default on debt obligation, then it means the default risk is high. If default risk is high, the credit rating will be poor, and then that will affect the yield to maturity and will ultimately affect the pricing of the corporate bond. And similarly, the liquidity risk is a risk that is linked to the trading of the bond. So if it costs more to trade, like in terms of the buying and selling, the transaction cost, if it costs more to trade, and in terms of the time it takes to trade, so if it costs more to trade and if it takes longer to buy and sell the corporate bond, then it means that corporate bond is illiquid. So it means it faces high liquidity risk. So so the corporations which are normally smaller in size may face high liquidity risk than the corporations which are larger in size. They may face less liquidity risk. Okay, so when it comes to the default risk and liquidity risk, we can use it to gauge we can link it to the credit spread. The credit spread is basically the difference between the yield on the corporate bond and the yield on the government bond. So government bonds are normally considered as risk-free investments, with treasury bonds, whereas corporate bonds are considered as risky bonds. Okay, so if we have to find the credit spread, we see what is the yield on the corporate bond, which is risky, and take out from it the yield on the treasury bond, which is normally risk-free. So the difference between these two will be giving us the credit spread. So how we can use the credit spread? So higher the default and the liquidity risk, the larger the spread will be. So it means if the default risk and liquidity risk of any corporation or the bond that the corporation issue, if it is higher, then the spread between the corporate yield and the treasury yield will become wider. So which means that because of the high default risk and high liquidity risk, the yield on the corporate bond has become larger, and whereas the yield on the treasury bond, if it stays stable, then the spread will become wider. Okay, so you can say credit spread is a very good indicator or a proxy for the default and the liquidity risk. Okay, so then it comes to credit ratings, which are given by the independent private companies to assess the possibility of default risk or liquidity risk in a particular company. The best known rating agencies, Moody's, Standard and Poor, and Fitch. And the credit ratings can range from investment grade, which indicates low default risk, or can be junk or high yield or speculative grade, which are basically the indication of the high default risk. So it means if you have to understand what is the default risk of any issuer, any corporate or any sovereign issuer of the bond, then you can look at the credit ratings. And if the credit rating is in the investment grade, then the default risk is less. If credit rating is towards the junk and speculative, then it is indicator of high default risk. Okay, so as an investor, you may want to heavily rely on the credit ratings, but that is a risk that you are relying on a third party, which is independent. But if you're concerned, you may want to use the credit rating as a starting point, and then you can do your own research to substantiate whether the credit rating you have got can be reliable or not. And the issue here is that because credit rating, if any corporation want to issue a bond, or if any government want to issue a bond, they will pay to the credit rating agency, and they will credit rating agency will rate the issue that the government or the corporation want to issue. So there is a conflict of interest. Investor has to rely on credit rating, but credit rating is asked by the issuer and paid, and then the credit rating agency may be influenced in that process. Okay, and we have seen big corporate failures where the credit rating was really good, but after some time, the company collapsed on their debt obligations. Okay. Okay, so this was a quick run through. Of course, debt investment or the bond investment is a subject in itself, and we can speak a lot about that. There are concepts like yield curve, uh, term structure, and then the duration. There are different types of duration, the sensitivity of the interest rate, the prices of the bond towards to the interest rate movement. So those things are beyond the scope of this subject. But what is our focus? Our focus is why does sustainability matter to bond investing? Okay, so this is what our focus is. But I wanted to make sure you understand what bond investing is first, and then we can talk about sustainability. Okay, so let's move on to the relevance of sustainability to bonds. So as I was saying, the left-hand side, we have environmental, social, and governance issues. And then on the right-hand side, we have the credit risk indicators. Okay, so what we want to establish is these sustainability issues will influence the credit worthiness of an issuer, may it be a government or may it be a corporation, and that will be reflected in the credit risk indicator. Let's say if there is any environmental issue linked to climate change, carbon emission, may it be social issue linked to human right violation or labor violation, health and safety. So our governance issues, lack of board independence, are the corruption at a country level. So environmental, social and governance factors at a government level or at a country level or at a firm level. So what we want to say is they have an influence on credit worthiness. So when it comes to credit worthiness of any company, so we can measure it through profitability, through the debt level of the company, through the employee productivity. So there can be different factors through which we can check the credit worthiness of a company. So, and then that credit worthiness is going to then influence the credit risk indicators. And one of the credit risk indicator is the credit rating. Okay, so then credit default spread, credit spread that I was referring, the difference between yield on corporate bond and the yield on treasury, that is another indicator, and bond prices is another indicator. So if we can establish this link from left hand side to right hand side through the channel of credit worthiness, then we can say there is a relevance of sustainability to the bonds. So there is an example, Volkswagen, when there was a Dieselgate scandal in September 2015. That's very famous scandal that has shaped the sustainable finance a lot. The CDS spread, which is basically a credit default swap spread, a measure of default risk. So higher the CDS spread, higher is the default risk. So the CDS spread after this scandal on 17th September was 75.5 basis point. Within a few days, by 28th of September, the CDS spread rose to 299.5 basis points. So you can see there is a significant increase, and higher the CDS spread indicate the higher default risk. So you can see the Volkswagen has an environmental issue here, and that increase the CDS spread here. So that's the two left hand side and right hand side. And here we want to emphasize that it is because of the factor that influence creditworthiness. Okay, so to look at it in greater detail, uh, here is the corporate bond, a spotlight on ESG issue. So we have the sustainability issues here, environmental, social, and governance. We have discussed these in detail, topic 3, 4, and 5. But you can see the type of environmental issues we discuss can be slightly different because it's still evolving. We discussed climate change. We also spoke slightly about biodiversity, and we have slight discussion about water, air, and other types of pollution, and waste management, and circular economy as well. And in social issues, yes, there are employee relations, human rights, community engagement, product responsibility, health and safety, consumer relation, access to skilled labor. So these are the social issues. And when it comes to governance issues, there are issues related to the board, shareholder right, incentive structure, audit practices, and there are other transparency issue as well. So here we want to say that these sustainability issues will affect the factors influencing credit worthiness, which includes profitability, productivity of the employees, competitive advantage, cost of capital, which I think Kastuba was referring to, and leverage. So if there are high issues here, that will affect these creditworthiness factors, and that will be reflected ultimately in credit risk indicators, which include credit ratings, breach of covenants, volatility, bond yield, default, and CDS spread. Okay, so traditionally, before we spoke about sustainability, the major focus was assess the creditworthiness of the corporate issuer and then try to come up with the credit risk indicator and then see whether you want to invest in that corporate issuer or not. But now what we are saying is we have to go one step back and on top, and we want to have a look at environmental, social, and governance issues that will ultimately drive the corporate credit worthiness, and that will ultimately have an effect on credit risk indicator. For example, if there is an extreme weather and the company is located in an area which is affected by a flood, maybe production will be disrupted, supply chain will be disrupted, and that will have an effect on profitability of the company, will have an effect on sales, maybe cost of production, and ultimately the profitability. And company may have to borrow more debt, leverage may go up, cost of capital may be affected, company may have a competitive disadvantage based on the location, which is more flood affected, and employee productivity, employee may not be able to reach the production plant, the employee productivity is also affected. So if this is happening because of the extreme weather in the climate change issue, then we can see that will spill over to the credit risk indicator. Maybe credit rating of that company will become worse. Okay, or maybe the default risk will go up, CDS spread will go up, volatility will go up, and company may be more likely to breach the covenants in the bond agreement. Okay, so this is one example of environmental issue. You can think about social and governance issue, how they can affect the credit worthiness. of the corporation, and then ultimately the credit risk indicators. Okay, so from here we see that the sustainability is relevant to the corporate bonds. When it comes to sovereign bonds, the government bonds, again, we can see there are environmental, social, and governance issues. They will have an influence on economic factors which affect the creditworthiness, and those economic factors are listed here: the economic strength, external debt, cash reserves, monetary policy, fiscal performance. So all those economic indicator, they are affected by environmental, social, and governance issue at a country level. So these sustainability issues at a country level will have an effect on economic factors which ultimately influence the creditworthiness, and that will spill over in the credit risk indicator, in the credit rating of a country, CDS spread of a country, the bond yields and bond prices. Traditionally, the focus was only at the economic factors that can be incorporated in measuring the credit risk indicators. But now we are saying a step ahead. We have to focus on sustainability issues because they are relevant to the economic factors, and those economic factors affect the credit worthiness, and that ultimately is reflected in the credit risk indicators. Okay, so these one are from the textbook, which you can have a look later. If you want to read more about these charts and further details, so at the bottom of the slide, there are links. So these links are from the United Nations Principle of Responsible Investment, PRI, which is a coalition among the institutional investors, asset managers, asset owners. So those that website you can explore later. Okay, so now we are moving into um, the sovereign bonds, and we want to establish that ESG scores or sustainability scores can have an influence on the credit risk indicator. And here the example that I'm selecting is credit rating. So if I go back here, so ESG score here, so is it related to the credit risk indicator here, the credit rating? So ESG score at the top, does it affect the credit rating? So here is the data from Sustainalytics. It's an old data, which doesn't matter because here our discussion is, does ESG score leads towards uh, better or worse credit ratings? Okay, so on the x-axis, we have the average credit rating of the countries, and on y-axis we have the ESG scores of a country. Okay, so it's a country level score. So the correlation between ESG score and ESG and the credit rating, the correlation is 0.77 or 77%, which is very high. So correlation ranges from -1 to +1. So the positive towards +1, it indicates that it's moving towards perfectly positively correlated. So 0.77 is very high correlation. So we can see as the countries which have high credit ratings and on the other side a high ESG score, so they are very much positively related to each other. For example, Australia, so their ESG score is around here, slightly lower than 80, whereas their credit rating is triple A or above. Okay, so that's the best rating we have here. So any countries here, you can say majority here are Scandinavian countries, Norway, Denmark. So they are leading the way. So their ESG score is very high, above 90, close to 100. So I think Norway is here, which is above 80, you can say. And then we have Denmark. So Denmark is also above 80. So they have high ESG score, and at the same time, their credit rating is also very high. On the other side, we have countries like Sri Lanka, where the credit rating is very lower, and same is the case. The ESG score is also lower. Pakistan, the country where I belong to, the credit rating is lower. The ESG score is lower. Students from India here, so you can see the credit rating between BB, triple B minus, and the ESG score of a country 40, and this data is based on 2017. Okay, so what we are saying here is the ESG rating at a country level is related to the credit rating. So it means sustainability is relevant to the bond investing at a government level, you can say from here. Then there is also an interesting indices available, corruption indices at a country level. You can say that measures how much corrupt a particular country is, and how much lack of transparency in a country is. Uh, so corruption is one indicator in governance. So G part of the ESG. So if you have to see where is governance, so this is sovereign bonds. So governance issue. So the corruption is here. So this corruption is part of the G in ESG. So we want to see how this corruption is related to the let's say the credit rating here. Okay, so based on the data here. So corruption G part with the credit rating. So this is again based on a UNPRI website, and here again we want to use this information just to establish G is relevant to the credit rating at a country level. So transparency index is here, the corruption perception index. So on the right hand side, if the score is greater, then it means low corruption. If the score is lower, it means high corruption. And here we have the credit rating given by S&P. So higher is AAA, low is B. Okay, so we can see the countries again, Finland, Denmark, the Scandinavian countries, they have low corruption and their credit rating is also very high. Whereas some of the countries, the European countries, Bulgaria, Romania, Greece, so they have the high corruption and their credit rating is also less. So from here, what do we infer is G matters for the credit rating of the country. So it means we have to integrate sustainability into that, like ESG into the credit rating at the bond investing at a government level. So if you click on this corruption index link, so you can go to the website which provide that corruption perception index, and this is basically a map. But on the left hand side, you should be able to see. So this is based on 2021, but you can see over time as well. So Denmark is number one, 88. I think it was the same 88 in the previous year. Yeah, 88. So and this year 88 as well. Okay, so Finland, the rank one, New Zealand rank one, Norway four, Singapore four. Want to see where is Australia? Australia is rank 18, 73 score. And then if we go bottom, what countries are at the at the high corruption level? So yeah, so you can see some of the countries which are struggling in terms of many issues: Somalia, Syria, Venezuela, Yemen, South Sudan, Korea, Afghanistan, Libya. So yeah, so their transparency and corruption index based on this data set is very high. So you can see the underdeveloped countries are struggling in that, whereas developed countries are achieving high. India is also here, 85. I don't know where is Pakistan, Sri Lanka is 102. Okay, so you can have a look at this at a country level, corruption at the transparency index. And if you want to see the credit ratings at a country level, there is a website, Trading Economics. So you can have a look onto that website. It does provide historical data as well. All the countries are listed here and three rating providers and DBRS as well. So their ratings are provided here by different countries. So you can have a look here. Okay, so what we have discussed here, the country ESG score is important for credit rating. The G part, corruption index, is related to credit ratings. And then there are some research papers which basically tells that corporate bond pricing is also related to the like sustainability is relevant to the corporate bond pricing. So previous two slides was based on the government bond. So these research papers are talking about the sustainability relevance to the corporate bond pricing. So the 2016 paper, what they have done, they have examined the relationship between ESG rating and corporate bond spread. So corporate bond spread is important credit risk indicator. So what they have found, the corporate bonds with high composite ESG ratings have slightly lower spreads. So lower spreads mean lower default risk. So it means higher the ESG rating of a company at a composite level, they will have lower spread and lower default risk. Atig et al. 2013. So what they have examined the relationship between corporate social responsibility and credit ratings, and what they have found, the good social performance or good corporate social responsibility leads towards better credit rating of a company. And issues like community relationship, diversity, employee relation, environmental performance, and product characteristics. So you can see these are a mix of environmental and social issues. So if they are demonstrated by a company in their ESG, then that will even significantly increase the credit rating. So not all ESG factors have similar effect on the improvement in credit rating. These factors which are just mentioned here, they have a stronger positive impact on the credit rating of a company. Okay, so this is my paper. Atif is my co-author in this paper, and Ali is my surname. In 2021, it was published. What we have examined the link between ESG disclosure and the default risk. Again, you can see default risk is one of the key indicator in assessing the credit worthiness of a company. Okay, so what we have found is we have found the companies which have high ESG disclosure, they have lower default risk. So again, better sustainability indicates less default risk in a company. And we have also found that this is through the channel of increased profitability and reduced performance variability and cost of debt. So, so these are the underlying factors. So if there is high ESG disclosure, the profitability level of a company goes up, the uncertainty in the performance or profitability goes down, and cost of debt of a company also goes down. So then ultimately that firm experience lower default risk. And we also found that the effect of ESG on default risk, it can vary from the life cycle stage of a company. The inverse effect of ESG disclosure on default risk is mainly existent for mature and older firms. Okay, so this is what I have done. I have few more working papers which are not published yet. So if any paper comes out, I'll share with you. Okay, so from here we see the sustainability is relevant to the corporate bond pricing. And then individual E, S, and G. So previous slide was talking about overall ESG, overall sustainability, but now we are talking about E, S, and G. So E matters. So this research have shown the negative relationship between good environmental management and companies' loan spread. So the loan spread goes down if the environmental performance of the company is good. This research shows that good employee relationship uh, decreases the likelihood of financial distress, and in other words, the likelihood of default of a company. So if the company have good relationship with the employees, then it does help in the survival of the company. So from here we infer S matters for the corporate bond pricing, and evidence of G matters. This is very seminal paper, heavily cited in corporate governance literature. So this paper have shown that stronger governance, which is in terms of more institutional owners in a company and more outside directors, or you can say from here independent directors. If more independent directors in a company, more institutional owners, it indicates strong governance. So if the governance is strong, the cost of debt of that company will be low. And if the cost of debt is low, then you can say the default risk will be ultimately low. So from here we understand G matters. So overall ESG matter for sustainability, for corporate bond pricing, the E matters, S matters, and G matters. So if it matters, then we have to integrate sustainability into bond investing. Okay, so what we have discussed so far, we have discussed the basics of bonds, traditional at a traditional level. Then we have discussed why sustainability matter to bond pricing at a corporate level and at a country level or sovereign level. So now we have said yes, it matters. How we can now integrate sustainability into bond investing. So at a sustainable finance version 2 through ESG integration, and at a sustainable finance version 3, we'll move on to the green bond, social bond, and other types of bonds which are available. Okay, so there was a survey uh, where the investment managers participated, and they have discussed uh, whether they pay attention to some level of responsible investment by different asset classes in 2016. So if any asset manager uh, pay little attention to the ESG issues or responsible investing in different asset class, equity, fixed income, or other asset class. So they are basically saying yes here. So we are not concerned about at what level, moderate level, high level, any level. Do you pay attention to sustainability issues in different asset classes? If yes, at any level, they are included in this survey in terms of how many of those pay attention to sustainability issues when investing in different asset classes. So you can say that 75 to 100% of the participants, they pay attention to fixed income corporate, also listed equity and other types of asset classes. Whereas when it comes to the government bond, so this SSA fixed income, this is basically government bond or sovereign bond. 50 to 75% of the participants, they said yes, they pay some level of attention to the responsible investing when they invest in fixed income SSA. So from here, we see that the government bond is getting less of a attention by the asset manager, by investment manager when it comes to sustainable issues, whereas fixed income corporate bonds get more attention relatively. And when it comes to equity, it also get more attention in terms of the proportion of the asset managers in that survey. So here I'm putting there, this is an overstatement as the figure lists the percentage of asset managers that undertake some form of ESG analysis. That is not necessarily in all their funds. And this is a survey which is basically the participants are the asset managers who are signatories to the PRI. So it means they are already in favor of ESG, and if they pay very less level of attention to ESG when investing in different asset classes, they are represented in this survey. So we can say this is an over investment of paying attention to ESG in different asset classes. There is a more recent survey available, ESG integration spreading in fixed income despite some challenges. So this is again at UNPRI website. So if I click on that, it will take us to the web page, and you should be able to see here ESG integration spreading in fixed income despite some challenges. So this article was written in May 2019. So here, if you see, so again, if you look at who are the respondents in this survey, so this is conducted by CFA Institute and PRI. So 1100 financial professionals, mainly CFA member from around the world, as well as workshop in 17 markets. So based on that, they have driven these statistics. So respondents who often always integrate material ESG issues into their investment analysis. So you can see the word often, always. It's not sometimes or little. So it means more often and always integrate. So when it comes to governance issues, environmental issues, and social issues, so no matter if it is an equity investing or credit investing, governance issues are considered more than environmental and social issues. When it comes to equity analysis and credit analysis, if you compare the two, no matter it is governance, environmental, or social issues, all these three get more attention in equity analysis and less attention in credit analysis. So 42% of the participants, they pay attention to governance issues when it comes to credit investing, 27% pay attention to environmental issues in credit investing, and 27% pay attention to social issues in credit investing. Whereas in equity investing, you can see all those numbers are much higher. So from here we see ESG integration in credit or fixed income investment is receiving less attention compared to the equity ESG integration into the equity analysis. And then it discuss why it is challenging to integrate ESG in fixed income as well as in equity, and number of factors are discussed here. So the dark bar is for the fixed income and the lighter bar is for the equities, and all those factors. When it comes to fixed income, the biggest challenge in terms of the ESG integration is limited understanding of ESG issues in itself is the biggest challenge to integrate ESG into the fixed income investing. So 37% of the participants said that, and then you can read further. And this webpage have further information which you can read later. Okay, so ESG integration into government bond investing, there is a Rebecca Sam country sustainability framework, which does give the sustainability rating at a country level. And if you look at environmental, social, and governance, there are three dimensions, and then there are several indicators and sub-indicators in all three: environmental, social, and governance. And ultimately, it gives the country sustainability score, okay, given by Rebecca Sam Country Sustainability Framework. Okay, so here how we see, because this is sustainability score of a country, how we can say that paying attention to this sustainability score means that you are able to integrate ESG into the government bond investing, because this is at a government or a country level. You see this factor governance, how much weight it is getting, 60%. So 60% of this sustainability score at a country level is driven by governance. And most of the credit ratings at a country level, they pay a lot of attention to the governance issue. So governance issue is one of the important factor in credit rating at a country level. So it means that this governance part is an overlap between the ESG rating at a country level and the credit rating at a country level. So from there, we understand that if we pay attention to Rebecca Sam Country Sustainability Framework, this is one way to integrate ESG into the government bond investing. And then it is basically a ranking of countries. Again, we can see Scandinavian countries, Sweden, Finland, Norway, Denmark. They are highly ranked. So country ESG score ranges from 1 to 10. So 10 is the best. So you can see this Sweden, Finland, Norway, Denmark, their score is higher than 7.5. And they are best rated countries. And this chart is for the top 10 country ESG scores in the Rebecca Sam Country Sustainability Ranking. And this data is based on 2017. Okay, so this in 2015, this same company, the provider of the ESG rating at a country level, they have shown the negative correlation between their country's sustainability ranking and country's CDS spread. So if higher the ESG score of a country, the lower will be the CDS spread. So in that way, if we use these Rebecca Sam country sustainability ranking, so it means in that way we can integrate ESG into the government bond investing, because these ratings are linked to the credit the CDS spread at a country level. Then if it comes to the ESG integration into the corporate bond investing, previously we were discussing the sovereign bond, the government bond. So when it comes to the corporate bond investing, there is an example by Robeco, which is an international asset manager firm, provide range of active investment options in equities and bonds. So what they do, when it comes to the bond investing, they give F score to a company, and based on that they see if F score is high, then it means more risk. If F score is low, then it means less risk in that company. So there are 5 dimensions to this F score: business position, corporate strategy, corporate structure, and financial profile. So these 4 are, you can say, they are traditional factors, whereas this ESG profile is basically where sustainability is brought into the credit rating, credit score assessment. So in that way, Rebecca, which is an asset manager, international asset management firm, is integrating ESG into their corporate bond investing. So they rate every company, they give F score before they invest in that company, and ESG profile is one part of that F score. So this is for your self-study interview with a corporate bond fund manager. There are different questions. What is the difference do you see between corporate bonds and equities? And what is your own approach to ESG investing? To what extent do you think ESG is priced? To what extent do you cooperate on ESG? Is there anything you would like to see changed, or any advice you would like to give? Okay, so this is an interview with the with the professional, and the response is given there. Okay, so now we are moving towards the final section of today's lecture, where we are going to talk about innovative financial instruments, green, social, sustainability, and sustainability linked bonds. What we discussed in the previous few slides, it was all about ESG integration into the government bond and corporate bond investing. Now we are moving into the types of bonds where integration is not needed. Green bond, it's already telling environmental friendly bond. Social bond, social friendly bond. Sustainability, which covers both green and social. Sustainability linked, again, linked to some social and environmental issues. Okay, so it means we don't need to integrate. uh, these financial instruments are already related to the sustainability, environmental, and social factors. So in that way, we will move from ESG integration, which is Sustainable Finance version 2, towards Sustainable Finance version 3. So what is green bond? Green bond are fixed income instruments where the capital raised is used to fund projects that tackle environmental or climate change issues. Okay, so the project for which the funding is sought, that project is aimed to solve some environmental and climate change issues. And the example of those projects can include renewable energy investment, creating low carbon buildings or upgrading pre-existing buildings, waste management, or water usage, or some pollution related projects. These are some of the examples of the projects for which, if the companies seek funding, they have an option to issue green bond. Once the funds are received, they will use those proceed for the projects which they intend to use those proceed for, and those projects are linked to the environmental and climate change issues. Okay, so these bonds are similar to non-green bonds where the ESG integration was needed, which we have discussed previously by the same company, except they are for a specific use. So green bond are for green projects. Okay, so that's the main difference. Whereas non-green bonds, which are traditional bonds, they can be for non-green projects. Whatever the company intend to use those funds for, they can use it. Okay, so the first green bond issue was you can say, if I show you here, so first ever green bond issue was made in 2007, and then first certified climate bond happened in 2014, and then in 2015, green bond market hit the 100 billion, the size of 100 billion in cumulative sense. Cumulative means every year new green bonds are issued. So if you keep adding them, so in 2015 they hit 100 billion, and then in 2016 first green bond sovereign issuance. So previously it was, you can say, more of a corporate green bonds. So first sovereign green bond was issued by Poland in 2016, and then in 2017 other countries also joined in: France, Fiji, Nigeria. And then the green bond market hit 250 billion in cumulative issuance. And then 2018, Indonesia, Belgium, Lithuania, and then Ireland, and the market hit 517 billion in cumulative issuance. 2019, more countries joined in, the market hit 783 billion. And then in 2020, green bond market hit 1 trillion in December 2020. And that's a cumulative, not on a absolute sense. So if I click on that, you should be able to uh, go to a web page where Climate Bond Initiative. So they have announced 1 trillion market reached in global cumulative green issuance. And there are interesting facts and figures provided there, which you can read later. Okay, so that was one thing that happened over the period of time in green bonds, how they evolved from corporate issuer to the sovereign bonds of different countries, and then in terms of their cumulative volume, the size, how they have touched the 1 trillion in cumulative sense in 2020 December. So you can see it's a fast growing financial instrument and receiving a lot of attention. Okay, so as the green bonds are coming more and more in the market, with the passage of time, green bond indices also came. So, like index provided, ASX 200, any 200 top market capitalization based companies, they are in ASX 200. So, green bond indices include issuers which issue the green bonds. They are part of those green bond indices. Bloomberg does provide green bond indices. MSCI provides some climate bond and green bond indices, so you may want to have a look at that later. So as there is a growth in green bond, there are more chances of the greenwashing. Companies can say something and do different. A company can say something positive, but in reality, it is less positive. Okay, so that is in general sense is a greenwashing. As the green bond market is growing, there is more chances the lack of transparency can happen, and the issuer may want to dodge the market participants who want to invest through green bonds. So to cater for that, there are different standards and principles that came in the market. So climate bond standards in November 2010, which is an initiative of the Climate Bonds Initiative. They came in the market and they have been giving the updates on that. So if I click on that, you should be able to go to the web page where we can see the climate bond standard. So you should be able to see now. So climate bond standard, you can download and see what this standard look like. What they intend to achieve. Confidence in green credentials of green bonds is essential to sustainable market. So companies which are saying that they need to use the proceed by issuing green bond for green project, how true they are, how transparent and accurate they are in their claims. So climate bond standard can help to help investor to gauge that. And then there is also certification scheme available. Certification is available for assets and projects that meet the requirement of the climate bond standard. And once the stamp is issued on that, it gives more certainty to the investors that this particular issuer meets the green bond standard which is required. Okay, so that is one thing happened, and then green bond principles in January 2014, first time came in the market, and given by the International Capital Market Association, and again the focus was to ensure the transparency. Okay, so if I click on that, it will take me to the green bond principle from the ICMA, and if you want to read more, so you can click on these handbooks and it will open the full principal guidance, and you can read the details later if you are interested. Okay, so over the period of time, this is happening, and these are the four principles from the green bond principles given by ICMA, and you can see use of proceed for which project the funds will be used for. Of course, green bond required the projects to be green and anything linked to the environmental or climate issues. And then the second principle is process for project evaluation and selection. The issuer should clearly communicate to investor what the environmental objectives are for that project, the process to determine how the project fit the eligible green project categories, and the eligibility criteria. So that's the principle number two. And management of the proceed once the funds are received, how to track and record. That has to be clear. So the net proceed of the green bond should be credited to the sub account and subsequently be tracked and verified. So you can't mix that up with other types of bonds. So it has to be a specific green bond subcategory where the tracking and verification can be done in the future. And then reporting is mandatory on the use of proceed. That reporting is required under principle 4. Okay, so if you look at the trend in the market about the green bonds, we see here the size of the market from 2020, 298.1 billion, and in 2021 it's increased to 522.7 billion. This is in absolute sense, not in a cumulative form. So in the cumulative form, we already know in 2020 the market has touched 1 trillion mark. Okay, so number of issues have also increased compared to 2020. In 2021, number of instruments have increased, Average size of the instrument also increased. Number of countries, now two more countries have issued the green bonds, and number of currencies in which green bond is issued from 34 to 33. So one currency has dropped from here. So that's the big trend. There are a few other uh, important trends. So if you look at this data from 2015 to 2021, and we have US billions on the y-axis, this is based on the regions. You can see in 2015, which is, you can say, close to the Paris Agreement, and after that 2016 onward. So 2015, the size was very less in US billion dollar, and majority of this was from Europe. So you can see that Europe is this one, majority from Europe. And as the time passed, you can see there is a significant increase from 2020 to 2021. There is a big jump, and the Europe is basically contributing, you can say, half of the green volumes in 2021. Okay, so you can say in green bond, in terms of volume, Europe is leading the way with half of the volume coming from Europe. So when it comes to individual countries, US is the largest in terms of the green bond. Sorry. So you can see here US is quite a lot, then followed by some other countries which are other than the listed here. China is also having quite a large of share in the green bond market, and then European countries, France and Germany, and then some other Italy, Spain, Norway are also there. Netherlands is also there. Okay, so this is country level trend. We can see what's happening. Where is Australia? Australia is not showing here in terms of the scale, in terms of the countries we have. Australia may be in other here. Top green corporations which have issued green bonds. You can see these are the companies in 2021. They have issued the green bonds. They did the largest issuer. So Ford Motor is one of them. You can read the story what Ford did with that green bond issue, but that's not the purpose here. What you can do for your assessment, you can see the company that you are evaluating. What is their plan to issue green bond? Are there any news they are thinking? Have they already issued? What about the players in the industry? What about the Australian market? Even Australian market, some public listed companies have issued green bond. Why not the company that you are analyzing? Is it a good sign or is it not a good sign? It doesn't matter. So things like that you can bring in there. So for which projects the proceed have been used in terms of categories? So you can see 80% of the green use of proceed went to energy, transport and building. And again, it's linked to the environmental issues. So energy, building and transport, they are most largest recipient of the funds received through the green bond over the period of time from 2014 to 2021. This is for your self-study. IFC International Finance Corporation, they have also green bond initiatives. You can have a look. So one is forest bonds and second is linked to the Amundi IFC Emerging Markets Green Bonds. This is again for your self-study interview with the green bonds fund manager. There are different questions. So just to check the perception of the green bonds fund manager, what they think about green bonds in general. There are also academic studies on green bonds. Green bonds have been found to have lower yield, around 2 basis points lower than non-green bonds. This is an interesting study by Flemmer in 2021, examining different issues in the green bonds. So what they have found is the stock price reacts positively when the companies have issued the green bonds. So the stock price goes up whenever the company issue green bonds. And if it is a first issue, there is more increase in the stock price. And if the green bond is certified by, let's say, a climate bond standard through by the climate bond initiative, if they are certified by that body, then the positive reaction in the stock price is higher because investors can trust on the issuance of green bond, and even so from here, what we see? We see a link between the green bond market and the equity market. So companies issue green bond. If it is a first issue and certified by the verified, then it will have a positive implication for the equity market in terms of the stock price. Okay, so that is one important green bond. Then we have a social bond. So green bond linked to the environment. In simple way, social bond is linked to the social factors. Okay, so according to the ICMA social bond principle, social bond is any type of bond instrument where the funds or the proceed will be exclusively applied to finance or refinance in part or in full to the new or existing eligible social projects, and if they are aligned with the four core components of the social bond principle. So ICMA, they have issued social bond principles as they have issued green bond principle, and they are very similar: use of proceed of project evaluation and selection, management of proceed, and reporting. So what are the examples of eligible social projects? Examples can include food security and sustainable food system, affordable housing, uh, access to essential services, maybe linked to resolving hunger, it's linked to food and security, maybe linked to the education, human capital development. So those can be the eligible projects for which the social bonds can be issued and proceed can be used for those projects. In terms of the trend, social bonds are relatively smaller in size compared to the green bond, and just started picking up the pace just recently. So the size of the market in 2021, it's dropped compared to 2020. I think COVID can be one of the uh, factor here. So 223.2 billion in 2021, and 2020 it was 255.2 billion. Number of issues have dropped. Number of instruments have significantly increased. Every size of the instrument is dropped. Number of countries have dropped, and number of currencies remain the same. Europe is leading the way in terms of the most of the social issuance. You can say 2018 it started, and in 2021, which is the last year of this data set, so Europe is this big bar. So they are contributing a lot in terms of social bond, uh, the size of the market. So in terms of individual countries, France uh, is the leading social bond issuer, and then you can see here it's part of the Europe as well. So it coincides with this chart. In 2021, Europe is issuing more social bond, and France is contributing towards that. And then it is basically the who is the issuer. So in 2021, if you see government backed entities, they are the major issuer of the social bond. Uh, Throughout the history, in particular recent history, 2020, 2021, government bond backed entities are the issuer in most of the social bonds. Okay, so then so what we have discussed one green bond, another social bond, so environmental issue and social issue, how we can help through the social and green bonds. So now we have one interesting variation to the social bond, which is the social impact bond. Okay, so they are not actually the bond, because in bond what happens? So there is an agreement, there is periodic coupon payment, and the end of the maturity date, there is a principal amount that is repaid back. But what happens in social impact bond? It is not like that. There is no periodic payment. Uh, the payment only depends on once the issuer of the social impact bond achieve the predetermined target. Okay, so that target can be linked to social factors, including if some criminals are there, how to reduce the refunding rate of those convicted criminals, helping students stay in school, more retention rate, homelessness, how to solve homelessness. So there can be predetermined social targets. If they are achieved by the issuer, uh, the issuer will get return on the invested, the investor will get the return on the invested capital. Okay, so it was first, so United Kingdom is leading the way in SIB. Australia is also issuing a lot of SIB at a state government level. And there is also Peterborough SIB was world first in 2012. Okay, so it's linked to the prisoners, how to reduce DDU funding rate. So how it works, just to give you a quick structure of the social impact bond issuer. So let's say there is a service provider, Silver Change, for example, and what the service, so the elderly patients, they receive the service from the service provider. So there is a bond investor. Now that bond investor want to invest through social impact bond structure, and there is a government, for example, New South Wales government. So bond investors provides capital via SIB, social impact bond, which is issued by a service provider, Silver Chain here. So the Silver Chain will use the funds to provide services to the elderly patients. And then the target is reducing the amount of time elderly people spend in hospital. Did the company able to achieve this target? If yes, then the government will give return of capital and coupon payment to bond investor. So return of capital and coupon payment is conditional on achieving the target. Whereas in social bond, it's regular coupon payment. At the time of the maturity, you get the the principal amount back once the bond is expired. But here it is conditional on the social target that is decided to be achieved. If no, bond investor do not receive any payment. So it means there is a risk involved in social impact bond structure more compared to the normal social bonds. Okay, so then a quick run through about other types of bonds that can help achieve sustainable finance version 2. Sustainability bond, which is basically a mix of social and environmental projects. So if any project target both social and environmental issues, and the fund is will be used for that project through the issuance of sustainability bond. That is basically a sustainability bond. So sustainability bonds where the proceeds will be exclusively applied to finance or refinance a combination of both green and social projects, activities or expenditures. So again, ICM may have issued sustainability bond guidelines as they have issued for green bonds and social bonds. So example of the project categories, eligible categories can include a range of social and environmental related projects. In terms of the snapshot of the sustainability bond market, you can see they are gaining momentum. So compared to 2020, in most of the indicators, there is a upward trend in 2021. The size of the market has increased, number of issues have increased, number of instruments have increased, number of countries substantially increased, number of currencies have increased. Only the size of the instrument have decreased compared to 2020. Okay, so when it comes to the breakdown of the region, supranational, like multilateral agencies like World Bank and IMF and some agencies like that, issued more sustainability debt than any region. Okay, so that supranationals are leading the way. In terms of regions, if you really have to pick, again, Europe is in 2021, you can see Europe and Asia Pacific, they are relatively closer to each other, and North America comes after, and Latin America have very small share in 2021 compared to other countries. Okay, and then again, here it's a country level breakdown. Supranational and USA is one of the leading issuers in the sustainability bond market. Then we have a sustainability linked bonds, which is different from sustainability bonds. So sustainability linked bond is linked to achieving some key performance indicators, which may be at times linked to sustainable development goals. So we have 17 sustainable development goals. So sustainability linked bonds can be linked to any one of these sustainable development goals. Okay, so the first sustainability linked bond was issued in 2019 by Italian utility. These bonds do not put forward a specific use of the fund. Instead, they target the outcome. Okay, so they say that we want to achieve a particular SDG goal and contribute towards that. So they issue the fund, no matter how they achieve that, in sustainability linked bond, it can happen. Whereas in sustainability bond, use of proceed has to be determined, and same is the case for social bond and uh, for the for the green bond as well. Okay, so if the issuer does not meet the target, then there is an increase in the coupon payment that is made to the investor. Alternatively, there may be a reduction in the coupon payment if they do meet their targets. And ICMA also provides the sustainability linked bond principle, as they provide for sustainability bond, green bond, and social bonds. And in terms of the snapshot, you can see it's picking up a pace compared to 2020. In 2021, all the indicators have significantly increased in 2021. And then there are some trends over the year. I think it's monthly data from 2017 to 2021. And then there are like the country-wise statistics as well. So Italy is one of the largest in terms of the sustainability-linked bond issuance. And then which sectors are getting the funding? Most of the uh, funds. So from here we see utilities, industrial, and then so utilities, industrial, they are receiving a huge share in their sustainability linked bonds. Okay, so that is it from me. So there are some additional resources from UNPRI website: an introduction to responsible investment, fixed income. ICMA website, it has a lot of guides and handbooks and number of principles on green bonds, social bonds, sustainability linked bonds, sustainability bonds. You can have a look later. And then there is a sustainability bond database which gives the the names of the companies or the issuers which have issued sustainability bonds. And when it comes to sustainable bonds here, it sustainable bonds include green bonds, social bonds, sustainability linked bonds. So all types of sustainable bonds. And there is a sustainable finance course which you may want to do it later, but it's heavily paid, I guess, once you get a job. And if your job is related to sustainable finance, your employer may want to reimburse you for that. And then climate bond initiative, you can go to the website. There is a heaps of interesting data available. You can explore that. And there is a report, 2021 global state of sustainable debt, and the charts that I have shown related to different types of green social sustainability bonds. They are basically extracted from this report. And there is again green bond training available. If you want to know more about green bond, you can watch out at different training options available. If they are free of cost, you can attend. If they are paid, ask your employer if they are happy to help you to get the payment.